Lesson 6. Income and Expenses. Personal finance involves managing the costs of living and maintaining a lifestyle. This is similar to a business, which needs to finance its buildings, equipment, labor, materials, and operating expenses. Individuals must cover their possessions and living costs. Just as businesses depend on revenue from selling goods or services to cover expenses, individuals rely on income earned through labor or investments. Understanding this process and the terminology associated with it is essential. In this lesson, you'll explore how to account for these financial activities. Income refers to the money earned or received during a specific period. There are different types of income because there are various ways to earn it. For example, income from employment or self-employment is called wages or salary. Deposit accounts, like savings accounts, generate interest, which can also result from lending money. Shareholders who own stock may receive dividends, while partners or owners in private businesses can receive a draw. In a market-based economy, there are two primary ways to earn income: by selling labor or selling capital. Selling labor involves working for someone else or being self-employed, with income typically coming in the form of a paycheck. Total compensation may also include additional benefits, such as retirement contributions, health insurance, or life insurance. This exchange of labor for income occurs in the labor market. Selling capital involves investing, which means using excess cash to provide liquidity, access to funds, to someone who needs it. Lending is one way to rent out capital, with interest serving as the payment or rent for using the funds. You can lend privately through direct arrangements with borrowers or publicly by purchasing corporate, government, or agency bonds on a debt exchange. Another example of selling capital is investing in corporate stock, where you exchange money for a share in the company's future value. Investments can also be made in assets like antiques, art, coins, land, or commodities such as soybeans, cattle, platinum, or crude oil. The concept remains the same. Investing involves either renting out capital or using it to acquire an asset that can later be sold or generate future income, or both. Capital is traded in the capital market, while lending occurs in the credit market, a subset of the capital market. This table below shows the different sources of income. In the labor market, the wage represents the price of labor that an employer, the buyer, is willing to pay to an employee, the seller. For a specific job, this wage is influenced by several factors, including the nature of the work, which determines the education and skills required. Other considerations, such as the job's status or appeal, may also affect the wage. The supply of labor for a job, how many people are qualified and interested in doing it, depends on the skills needed and the job's attractiveness. If the supply of labor exceeds the demand, meaning more people are available than jobs are needed, employers have more choices, creating a buyer's market. In this situation, employers can hire at lower wages. Conversely, if demand exceeds supply, with fewer workers available than jobs, it creates a seller's market where workers can negotiate higher wages. Jobs that require fewer skills tend to have a larger pool of potential workers, leading to a buyer's market. In contrast, jobs requiring specialized skills have a smaller labor pool, giving workers more bargaining power in a seller's market. People invest in education to gain advanced skills, increasing their competitiveness and positioning themselves for jobs in a seller's labor market. When starting your career, you are typically in a buyer's market, mainly because you lack experience unless you possess a unique skill or talent. As you gain experience and develop new skills, your career progresses, allowing you to sell your labor in a seller's market where you have more bargaining power. Even if you change jobs or careers, The goal is often to improve your position and increase your leverage in the labor market. However, many people value their work for reasons beyond pay, such as intellectual satisfaction, social interaction, or personal fulfillment. While labor serves as a source of income, it is also a tradable commodity with a market value. Although personal rewards may influence your career decisions, it is important to remain aware of the financial implications of those choices as you make them. Your ability to sell labor and earn income depends on your position within the labor market. Early in your career, you can expect to earn less, but as you gain experience and develop skills, your earning potential typically increases. Many people aspire to eventually stop selling their labor entirely, aiming to retire and focus on hobbies or other interests. Retirement becomes possible when alternative sources of income, such as earnings from savings or investments, replace income from selling labor. Capital markets exist so that buyers can buy capital. Businesses always need capital and have only a few ways of raising it. Sellers and lenders, on the other hand, have many more choices of how to invest their excess cash in the capital and credit markets, so those markets are much more like sellers' markets. The following are examples of ways to invest in the capital and credit markets: buying stocks, buying government or corporate bonds, lending a mortgage. The market for a specific investment or asset can shift between being a seller's market or a buyer's market, depending on economic conditions. For instance, markets for real estate, modern art, sports memorabilia, or vintage cars may favor buyers if there are more sellers than buyers. Generally, though, the demand for capital often meets or exceeds the available supply. The more capital you have to sell, the more opportunities you have to market it to a broader range of buyers, potentially increasing what those buyers are willing to pay. However, for most people, especially early in life, selling labor remains the primary and most practical source of income. Expenses are the costs associated with using items or resources needed for daily life. These costs are recurring, as essentials like food, housing, clothing, and energy are consumed regularly. When your income is less than your expenses, you experience a budget deficit, meaning you lack the cash needed to meet your wants or needs. A budget deficit is unsustainable over time and requires action to address it. You can eliminate the deficit by 1. Increasing your income, 2. Reducing your expenses, or 3. Borrowing money to cover the shortfall. While borrowing might seem like a quick fix, it adds another expense: interest. If income doesn't increase to offset the additional cost, borrowing will only worsen the deficit in the long run. The table below shows the choices created by a budget deficit. When your income for a given period exceeds your expenses, you have a budget surplus. This is a sustainable and financially viable situation. You might decide to reduce your income, such as by working less, but more often, you would use the surplus in one of two ways: increasing consumption or saving it. If you choose to consume more, the surplus is spent and gone, although it may bring enjoyment or other benefits. If you save the surplus, you can store it for future use, perhaps in a piggy bank or jar. However, a more effective way to save is to invest it. This could involve depositing it in a bank account, lending it to earn interest, or using it to acquire assets like stocks, bonds, or real estate. These investments allow you to sell your excess capital in the capital markets, helping to grow your wealth over time. The following are examples of savings. 1. Depositing into a statement savings account at a bank. 2. Contributing to a retirement account. 3. Purchasing a certificate of deposit, also called a CD. 4. Purchasing a government savings bond. 5. Depositing into a money market account. In addition to expenses, there are two other significant types of costs that impact your financial decisions. Imagine you have enough money to buy either a new jacket or new boots, but not both, due to limited resources. If you decide to buy the jacket, you cannot buy the boots. The opportunity cost of choosing the jacket is the value of the boots you gave up, your next best alternative. Opportunity costs are always present in personal finance. The goal is to make choices that provide more value than cost, ensuring the benefit outweighs the opportunity cost. In this case, you chose the jacket because you determined its value to you was greater than the cost of not having the boots. Opportunity costs also influence financing decisions, like whether to borrow money or use your savings. Borrowing has clear costs, such as interest payments, while using cash or savings may seem cost-free. However, using your own cash carries its own opportunity cost. You lose the interest that money could have earned in savings, and you also lose liquidity. Without liquidity, you may lack funds for other needs, like a better opportunity or an emergency, potentially forcing you to borrow at a higher cost. When buyers and sellers make decisions, they often consider the opportunity costs and may experience regret, especially if the benefits from their choices fall short of expectations. Regret can influence future decisions, sometimes preventing us from recognizing sunk costs. Sunk costs are expenses that have already been incurred and cannot be recovered. Once resources are spent, they are gone, and there is no way to get them back. Decisions should be based on future outcomes, not past actions. After a trade is completed, it's finished, and understanding that sunk costs are irretrievable can help you make better decisions moving forward. An example of sunk cost is the money you spent on your jacket. If it snows next week and you realize you need boots, the money spent on the jacket cannot be used to buy the boots. If you want the boots, you will need to find another way to pay for them. Unlike the clear price of an item, opportunity cost is less obvious. People often focus on the benefits they receive from a trade, not on what they are giving up. While this optimistic outlook can be a positive aspect of human nature, it can also be a weakness in making strategic financial decisions. People also tend to focus too much on sunk costs, but no amount of regret can change the past. Learning to recognize sunk costs is essential for making sound financial decisions. In conclusion, understanding income and expenses is fundamental to managing personal finances effectively. Income, whether from selling labor or capital, is the foundation of your financial situation. It determines your ability to cover expenses, which are the recurring costs required for daily living. When income exceeds expenses, you have a budget surplus, which provides the opportunity to save or invest. Conversely, when income falls short of expenses, you face a budget deficit, requiring you to either increase income, reduce expenses, or borrow. Opportunity costs play a crucial role in financial decision-making, as they reflect the trade-offs you make when choosing between options. Whether purchasing a jacket instead of boots, or deciding between borrowing or using your savings, the opportunity cost is the value of what you give up. Recognizing sunk costs, expenses that cannot be recovered, helps in making better future decisions. Focusing on the benefits of a trade rather than past choices or regret will lead to more rational financial planning. In the end, good financial decisions involve balancing income, expenses, and opportunity costs while avoiding the trap of sunk costs. By understanding these concepts, you can build a stronger financial foundation, make more informed choices, and move toward greater financial stability and wealth. See you in the next lesson.